All right, welcome everybody. Week 4 of our options trading course. Good to see you here. Let's get started. So just before we do, quick disclaimer that anything discussed in today's presentation is for educational purposes only and should not be considered investment advice, financial advice, or a trade recommendation. No representation is being made that any portfolio will or is likely to achieve profits or losses similar to those shown. Make sure you check out the disclosure document, characteristics and risks of standardized options available from optionstradingiq.com/risks. Alrighty, yes, glad to see everyone got here despite the change in daylight savings, so that's good. Plan for today is we're going to look on our case studies, see how they're doing. We're going to talk a bit more about butterfly spread adjustments and calendar spread adjustments because we only covered that fairly briefly last week. Then we're going to introduce the iron trapdoor. I know some of you have done the homework already and you've already started looking at that trade and how that's set up, and we'll talk a little bit more about setup and how to manage that particular trade and the advantages and disadvantages. And then we're going to do a bit of review in terms of what we've covered so far in the course and go back over some of the basics, answer any questions, that sort of thing. Alrighty, so let's go and check in on our case studies first. All right, let's look at BA, do it in alphabetical order. So short-term trade, so it's a little bit hard with this one to adjust, but basically we've hit our sort of upper adjustment point where we're basically flat on the trade in a slight profit. We've got a bit of negative delta here. Obviously, we want the stock to go back into the middle of our calendar spread. So we want price to go down. So it makes sense that we'd have negative delta. And you can kind of see that with the purple T+0 line. If the stock rallies, we're going to lose. If the stock goes down back towards 210, we're going to do well. And then obviously if it goes a lot further down, we're going to flip to positive delta because we're going to want it to come back to the middle here. So let's take a look at BA. And it's kind of in no man's land. It's kind of stuck in between the moving averages. Small chance it might come back to 210, but no real opinion either way. There's a little bit of support here with that moving average. The blue line is the 50. The green line is the 21. So they may provide a little bit of support, possibly a little bit of support here from this little gap just below 214 or around 214 as well. So there's a little bit of support below. So what could we do with this trade? Well, as I said, there's only a week to go. So they get a little bit trickier to manage here into the last week, but a couple of ideas of things that we could do. Let's say we don't think BA is going to come back down to 210. We think it's going to stay where it is, or come down a little bit, maybe higher. So we want to try and reduce some of the risk on the upside. One thing we can do is we can move the long option. So we could sell this 210 put. So we're going to sell that for about $330, and we could move it lower. So buying this one's going to cost $214. So we're selling for $330. We're buying for $215. So it actually, the net result is going to be a credit into our account of about $120. And if we do that, so we take that one off and we move it down there, it adds risk on the downside, but it reduces our risk on the upside. So that's certainly a possibility. Gets us back a little bit more delta neutral. We're going to start making money, slightly lower, even slightly above. We'll see if we can. It gets a little hard as we get close to expiration. The T+0 line isn't quite as accurate on interactive brokers. But you can see there, even if it rallies up a little bit, we might still get a little bit more profit. An ideal scenario is somewhere down here around 212, 215 is going to do really well for us. So I think that's a pretty decent adjustment and something that's pretty simple. The other thing I looked at was going even further down and buying the 200 put, but that adds quite a lot more risk on the downside. It does pretty much eliminate all risk on the upside. So that's something that you might consider if you were quite bullish on BA. You felt very, very confident that it wasn't going to drop much more. And see, by doing that, we've actually flipped to positive delta. So again, we're selling that for $330, buying this for $140. The net credit's about $190 into our account. Eliminates all of the upside risk, but adds risk on the downside. But we've still also got our profit zone here, and we can make money if it does drop into this zone, as long as it doesn't drop too far or too quickly. So this would be a valid adjustment strategy as well. Particularly, if I did something like this, I'd want to close out if the stock broke below 210 I wouldn't want to, we talk about that purple T+0 line. We don't want to roll down the hill too far. So I'd want to close out if it got to about 210. Let's just change that back to T+0. So you can see we're going to lose quite a bit if it goes to 210 as of tomorrow. So certainly wouldn't want that to happen in the next day or so. But as we get close to expiry, in around here between 210 and 215 is going to be okay. But certainly with this sort of setup, I wouldn't want to hold it if the stock broke below 210. So there's a couple of different options there. I think this is kind of in the middle. This is a reasonable adjustment here, doing this one. Yes, we could absolutely roll it out as well. So by doing that, we would, let's go back to our original position. We'd close out this calendar. If we still thought BA was going to come down to 210, but maybe not in the next week, maybe we want to give it another week or two after that, we could absolutely just roll that out. What we'd end up doing is we'd be short this one. So we'd go out another 2 weeks and add a 210 put. So what we'd do, we'd close this one out. So we'd buy this one to close, we'd sell this one to close, gets rid of that. And then we'd end up actually selling the same one and buying further out in time. So basically just rolling out another 2 weeks. And that would be our new expiration dates. Done something wrong there. Sorry, December 3. So basically taking the position off for a slight gain, I think it was $8, basically enough to cover commissions and slippage, and we'd roll it out again. Now we're still kind of out on that upper end of the calendar, so you'd want to be confident that BA is going to come back into this zone. Or if you wanted a more neutral trade, you'd take the initial trade off, you'd reposition for 2 weeks out and put it at 220. So that's certainly an option as well if you wanted more of a neutral trade. So you could roll just the short leg. Yep, we can take a look at that. And that would be, so that's our initial position. So you're saying take this one off and roll it up to say December 3, turn it into a vertical spread. I guess you'd buy this one to close and then you'd sell this one, for example, if you're confident it's not going to get below 210. So that's going to change it into quite a bullish trade. We'd take that one off and sell this one. So we're buying this one for 120, selling this for 215, generating about $95 credit. And we've turned it into it's actually a bearish trade because we've got that one is the long and that one's the short. So you could do that if you were bearish. I think this is probably the best one in terms of keeping it pretty simple and holding that into next week. Okay. Any other thoughts or questions on the BA trade? All right, let's go to Microsoft. So Microsoft's done pretty well. That unrealized is actually incorrect. It's up about $100. So that one's done really well. Let's just go and check on the chart. So we opened this a week or two ago back here. We were looking for it to go kind of sideways, and that has happened. So that's been good. We've kind of got into this overbought territory here. We're starting to work off those overbought conditions a little bit. And Microsoft's really quite strong. I'd say it's likely to stay pretty elevated. I don't see it really dropping a whole lot. So in terms of our position, I think we're actually positioned pretty well here. I think there's a good chance Microsoft can hover around this 335 level. This trade initially cost us about 170 and it's now worth about 270, you can see there. So we've made about $100 on the spread. So 100 in profit over the 170 cost per spread. It's about a 58, 60% return. So I'd also be quite happy to close that out here rather than taking it into the last week, because that last week can, the P&L can fluctuate pretty rapidly, pretty violently. So those are really the two choices: hold for another couple of days or take the profits. There's not really any sort of adjustment we can do here, nothing really that we need to do. So I think that's pretty much the two choices: is take the profit or hold for a couple more days. Any thoughts on Microsoft? Take profits and close. Yeah, I agree. Alrighty. And the Condor that we've kind of hedged, our hedge has actually done pretty well for us. Remember, the stock or the ETF was dropping, so we sold some shares. We've made a little bit of a profit on our Delta hedge. We've protected our position a little bit. We're kind of defending this short strike. By adding that Delta hedge, notice that we've reduced our risk on the downside as well. The capital at risk on the upside is much higher than on the downside. And we're looking pretty good. Again, ignore that because we've made a slight realized loss. We adjusted some of these spreads. So we're up about $60 on about 1,000 capital risk. So it's about 6%. It's a little low for a Condor. Typically, you want to get closer to that 10%. But I'm pretty happy with where this is right now and pretty happy to kind of close that out. Similar to Microsoft, you could maybe hold it for a few more days if you're going to hover in here. Starting to pick up some pretty decent time decay, $13 a day. So the only real risk, as you can see, we've got positive delta dollars. The majority of the risk is on the downside. If the stock keeps dropping, we'll make back a little bit more profit if it rallies a little bit. We're in a pretty good position on that T+0 line. We're still pretty flat here. We're not really rolling down the hill yet. So overall, I think we're pretty good. We're delta 10 here, but you know, that's quite a low delta. Normally our rule of adjusting is about a delta 25, but because we're so close to expiration, that 10 delta is actually a lot closer into the stock price than it would be if this was a 30 or a 45 or a 60-day trade. So you don't want to be sort of lulled into a false sense of security that this is a low risk 10 delta, you know, 90% chance it's going to expire out of the money. You know, we could easily see a big drop here and starting to get under pressure pretty quickly. That's the challenge with trades as they get close to expiration. Some of our rules kind of change a little bit, and I'm always quite reluctant to take trades into that last week. The only exception would be is if this was just a regular Condor and the stock was sitting right here in the middle at 225. In that case, I'd probably take it into the last week and just let everything expire, because it's very unlikely that it's going to see those massive moves out to, you know, 255 or 195 in a week from 225. But in this case, sitting in this spot here, a little bit of a profit. I'd hate to see this start to go down here and we give back all of our profit and end up in a loss situation. So for me, I think this one is a close as well for multiple reasons. One, that we've got a decent profit. We're getting to that last week, which we know is quite risky. And we're not really in the middle of the Condor. So definitely think this one is a close as well. All right, so I think that's 4 successful case studies. And then on the coin one, we closed out early for a loss. With what's happened over earnings, that one actually would have been a full profit as well. But I think we did the right thing by closing early. If you remember, just wait for this to come up. We sort of rallied up here pretty hard and it was looking a bit scary, like it was going to keep going. So better to take a loss when you can rather than later on when you have to. And you never want to take a full loss on any of these vertical spreads, right? You should never be getting to that situation where the stock gets through the short strike and you're sitting on a full loss. You always want to take that loss or adjust before it gets to the short strike. In hindsight, you know, the stock was pretty overbought. Maybe we could have adjusted or delta hedged. but decent example. You could go back and look at that one again. If you've got Option Net Explorer, you could go through and set that trade up again and take a look, around this time instead of closing or whatever it was. It might have even been back here. I think it was quite early on. What would have happened if we had have done some of those adjusting strategies that we talk about, taking the short call spread off, rolling it up, maybe a bit of a delta hedge, adding a put spread, things like that. You can work through those different scenarios, see what you could have done differently, and possibly still come out with a winning trade. So that would be a good exercise to go through if you've signed up for your Option Net Explorer trial. All right, so on to the trapdoor. A few of you've done the homework, which is great. So I've got an example here. There was a little curveball with this one, because if we go and look at the standard monthly expirations, and this is a bit of a strange situation. Normally you'd have lots of strike prices available, but when we go out to December and we go out to our 10 to 15 delta calls, here's 17, 10 delta, 6 delta, they're 50 points wide. Normally these would be sort of 10 points wide, but for some reason we haven't got enough strikes up here. The 10 points wide stops at 2,500. So it means it makes it much harder to do a condor and a trapdoor on the Russell, but some of you picked up on that, which was great. And you looked at adjusting that to either the December 10th expiry, which does have 5-point wide strikes. So it means we can do trapdoors and condors on this expiry. And same with the December 23rd. We can get our 15, 10 deltas here, and they're all 5-10 points wide. So very strange that we'd see more strikes available in the weekly options than the monthly options. The other issue with weeklies is less liquidity. There's a lot of open interest here and not a lot of volume, and the spreads are a bit wider. The spreads are just a little bit tighter here. We've got a lot more open interest and volume in the monthly. So I'm really surprised that we don't have those 5-10 point strikes here. They may come out at some point. And even if we go out, I didn't actually check January, but I think someone said, oh no, we do have, we have just 20 points wide here for those 10 deltas, or if we came in a bit closer, we've got 10 points wide. So with the trapdoor, what we do is we've got our first piece we always do is the call spread. We always go at about a 10 delta for the short call, and we do 2 contracts. So that's our first piece. Ignore the risk graph for now. The next thing we do is we buy a debit spread. So normally we've been looking at mostly credit spreads so far. This time we're doing a debit spread. So a bear put spread rather than a bull put spread. So we're going 20 points below the index price for our long put. So we buy 2 of those and we go 20 points wide, we sell 2 of those. This piece is always pretty much set in stone. 10 delta bear call spread, 20 points below for a bull put spread. Then this piece here is kind of variable. And what we want to do is we want to adjust this piece to get a position that's kind of delta neutral. Usually with this position size, it's going to be about 7 or 8 contracts. So I usually start off with 8, for example. And I look at that and I'm like, oh, okay, that has a slightly positive delta, 3,700. So we can vary the trade by doing 7 contracts and look at that delta 0, delta neutral, and delta dollars. So this is the only sort of piece that's variable. We can kind of adjust the strikes a little bit as well. The only slight issue with this trade is the profit potential if the stock stays flat. It's only about 250. See this blue line here, this expiration line? I prefer this to be up at around 500. But otherwise the setup is pretty spot on. So well done for the couple of people that did that and posted that in the chat room. Yeah, the Russell's the only one I do this on. Now, if you remember back to our discussion on volatility, part of the reason why this trade works is if you think about the difference between this and a condor, we're only doing 2 call contracts. So we're selling 2 bear call spreads and we're doing 7 of the put spreads. Remember volatility, we want to sell high and buy low. Well, we're actually selling here as well, but we're selling less contracts where volatility is low, and we're selling more contracts where volatility is high. So we're taking advantage of the skew, the volatility skew in the Russell. So here, remember we talked about the Russell always has the puts a higher volatility. So we're getting more bang for our buck by selling these ones. Okay, so we sell more of these ones than these ones. The other advantage of this trade is compared to a condor, when people start trading condors, they're always worried about the downside. They're worried about flash crashes, things like that. I've actually found, and partly that's because we've been in a bull market for the last 10 years or so, but most people get into trouble on the upside with condors. So what are some things that you notice about the trapdoor? Well, there's a lot less risk on the upside. We're only risking under $4,000 here, and on the downside, nearly 10,000. So it's going to handle an up move a lot better. Notice the T+0 line also is quite a bit flatter on the upside. We don't have that steep hill to fall off if the market really rallies hard. We've got more risk on the downside. That hill is much steeper on the downside. So if the Russell moves up 5, 6, 7% in a few days, we're not losing too much on the upside. In terms of time frame, yeah, same as any other condor or credit spread, around 30 days is kind of the minimum, up to around 60 days. I wouldn't trade anything more shorter term than 30 days. You could potentially go longer than 60 days. You could maybe go out to 90 days, but anywhere sort of 45 to 60 days is kind of the sweet spot. All right, so let's look at another example. If we were to go out to January, and we'll set it up from scratch together. So let's see if we can find some good strikes for January. There's our 10 delta, 20 points wide. We're still going to be 20 points below, so we're at 24.10, so we go 23.90 and 23.70. Then we find our 15 delta on the puts, roughly there, 21.30, 10 points wide. So first step is to sell the 2 call spreads. Then we buy the 2 put spreads. And then we've got our variable piece, which will start with 8 and change expiration. And we've got slight positive delta again. So looks like 7. Now 7, we're getting slightly negative delta. So let me reset that T+0. So nice and flat again. You see kind of longer term, so flatter T+0. So you would just choose either 7 or 8 contracts, depending if you wanted to start with slightly negative or slightly positive delta. I actually quite like starting with slightly negative delta, because notice we've also got negative vega. So if the market drops, typically we're going to get hurt by volatility, because when the market drops, volatility goes up, right? So I don't mind starting with a little bit of negative delta. So we might actually get a little bit of a help from that negative delta that offsets the rise in volatility. Yeah, look, it's a bit of an advanced trade, so it's not really recommended for beginners. And again, you're needing minimum 10,000, so probably only if you've got sort of 100 to 200,000 account. You can go half position size as well, and you can do IWM. The trick with IWM is you've got to watch out for early assignment, because the Russell is European, so there's no risk of early assignment. The risk with IWM, if it gets down here and some of your short puts are in the money, you just need to watch for early assignment. What if it goes haywire? Well, there's a few sort of easy adjustment strategies we can do. If the market rallies hard to the upside, we can just easily sell the debit spread and turn it into more of a condor shape, lots less risk on the upside. That's a really easy adjustment. Because we've got less risk on the upside, we can also take these off, roll them out in price and add contracts, which doesn't take up any more capital at risk. So we can do a combination of those things. And then same sort of rules on the downside. If this gets to delta 25, we want to play a bit of defense and roll them down and things like that. Mahesh says, what market conditions work better? So again, it's a negative Vega trade. So you typically want to enter when volatility is a little bit higher, usually when the Russell's had a little bit of a sell-off. That's a good time to enter. Cool. So let's go back to our initial December example. Let's just take a little screenshot of those Greeks and we'll do another little comparison with a condor. So let's say we weren't doing a trapdoor, we were doing just a standard condor instead. We wouldn't have this piece and we'd have the same number of contracts on the upside and the downside. See how that T+0 line is much steeper, drops off a lot quicker. So that's one big difference. This across. We're pretty similar in delta dollars, slightly more negative on the condor. Gamma's the same. Theta's higher in the condor, but Vega's a lot lower. 131 versus 240. So the trapdoor will handle a volatility spike a lot better than a condor will, because you've got a much lower Vega. And the trade-off is slightly lower theta. Anyway, it's quite a fun trade and certainly one that, you know, once you get a bit more experience, you can start looking at things like this, which is quite fun. So if you want, we can set this one up as a case study. You guys can decide where you're going to set your alerts. Let's change this to Russell. Anyone want to take a stab at where we might set some alerts on this one? Twice the credit received, yeah, that's not a bad idea. I'd set some price alerts as well. Where do you think we'd put price alerts? I'd say down about here, somewhere between 2275 and 2300, somewhere in here on the downside, probably 2300. That's where I want to be starting to adjust or hedge. 23.25, yep, you could certainly do there. You're going to be adjusting a little bit earlier, but that's okay. Yep, for me, probably 2300. And then on the upside, probably between 2500 and 2525. All right. So let's go back and review some of the basics that we've covered in the course so far. If there's any questions, pop them in the chat, but let's go back to the start and think about how do we find trade ideas? Okay. Dow stocks, remember we're doing our candle glance here on stock charts. Great place to look for trades, very high liquidity. We can get a quick look at what's happening in some of these stocks. Typically, when we're seeing quality blue chip names being really oversold, they typically bounce back. We can also look at stocks that are kind of respecting moving averages. Amgen respecting that rising 50-day moving average potentially. Stocks that are in nice trends. See Caterpillar here has had a declining 50-day moving average. 50-day starts to rise, holds a support. Series of high highs, high lows. So Caterpillar is a nice bullish idea. American Express looks pretty good. Then we can do stock screeners as well. So FinViz is free. There's a few other free ones as well. We talked about a few different ways we can use these screeners. Can I share the URL? This one. Let's see if that works. Yep. That way, hopefully you can just click on that and it will bring everything up for you. Good suggestion. Then another way is, let's say we want to look at stocks in the S&P 500 that are deeply oversold. So we can do some contrarian trades, nothing deeply oversold. PayPal's been kind of crushed lately, hasn't it? So this would be an example. If you wanted to get long PayPal, it's a contrarian trade. We're trading against the trend. We're trading against the money flow. So it's a bit higher risk, but the rationale for the trade might be that we think PayPal's really oversold here. We think it's not going to go too much lower. Maybe it's going to go sideways. Might be a good candidate for a condor, potentially, because it's in a nasty downtrend, but it's also oversold. So maybe it's not going to go too much lower. Maybe it's going to bounce around sideways for a month. Could be a good condor. Or you could do a long-term put spread, potentially, if you think the stock's going to bounce back eventually. So let's look at those two ideas. So PayPal, December, 35 days. So that's pretty much, pretty good example time frame. Remember, we don't want to be, once we get down to sort of 21 days, 3 weeks, that's getting a bit too short term for me anyway. You might be different, but for me, this is pretty good. There's a 15 delta on the puts. So we'll add a 5-point wide where we've got 36, 38% IV here. On the upside, there's a 10 delta, there's a 15 delta. Volatility is pretty similar, a little bit higher in the calls. Let's add a few different ones. So if we're going to do a condor, we could do 2 put spreads and 2 call spreads. Let's see how that looks. I've gone too wide there. We didn't have 5-point wide strikes. So to even that out, we could either add the 170 puts and go 10 points wide, or we could do 4 contracts. Ends up being the same. So a little bit of a problem here, as you can probably see. We're kind of skewed. We're too close on the downside compared to the upside. And you can see that by the fact we've got positive delta dollars as well. We'd need the stock to go back up into the middle. So we'd either need to bring the calls in a little bit or move the puts out a little bit. Starting to look a little bit better, still kind of skewed a little bit with positive delta, but that might be okay. Yeah, exactly. If you were bullish, you could do that, absolutely. And you can do things like unbalanced trades as well. Like you could just do the 1 contract. So something like that, if you're bullish, makes sense as well. Yeah. That's what I'd call an unbalanced condor. You can do that for sure. So that would be one idea on PayPal. The other would be if you think long-term it's going to bounce back, we could go like a really long-term, really slow-moving put spread. For me, I'd be happy to go out to sort of June or even September next year. 15 delta is going to be really far out of the money. There's a 16 delta. And we sell 2 put spreads. So we're selling the June 160 put. We're buying 2 of the 155s, generating about 180, 190 in premium over 810. So pretty decent return potential and a pretty big margin for error on the downside, over 20% before our short strike gets tested. And that's going to be quite slow moving. Let's plug that into our calculator. So if we were to do this trade, my Excel keeps doing that. Sorry, 1 second. There we go. Oh, having issues with my screens here, sorry. There we go. So we got June 17, 22 is the expiration date. We're short 160, we're long 155. Oh, sorry, that's the stock price. 202.38, 160, 155. And the spread is trading for roughly 522 minus 439. It's about 83 cents. Generating $83 in premium over 400 at risk. Oh, we're doing 2 contracts. So generating 166 over 834, 19, 20% return potential, which works out to about 33% annualized with a 20% margin for error on the downside. If I was bullish on PayPal or I thought it was going to not drop too much more, you know, that's a trade I would consider. Any thoughts on any of those ideas? Hey, Paul, that's my personal preference. Paul's asking, is it typical to go out that far when playing a rebound? So for me, I want slow moving trades that I don't have to monitor too much. So I would go out to June, but you could go shorter term if you're, you know, happy to monitor those trades a bit more closely. You could go with December. That's absolutely fine. You get more time decay. Totally fine. This is just my kind of personal preference. But yeah, you could do something like the December one that we looked at as well. So a bit of homework for you. Set those up as a case study. Set some price alerts and follow them along. Ask questions in the chat room as PayPal moves around. Let's discuss how these ones are going. Gresh asking, do you recommend leaps for put spreads? If so, which situations? I'm under the impression that leaps are done mainly for buying calls. Yeah, leaps are good for what I call a poor man's covered call, where you buy that long-term in the money call and sell monthly calls against it. Really popular strategy. But yeah, no reason why you can't do put spreads as well. Yeah, why not? As long as the volume and the liquidity is there, for sure. What's another thing here? When we're doing 35 IV here, slightly higher IV in the shorter term one. So what's that called? When short term IV is higher than longer term IV. Who remembers what that's called? Backwardation. You got it. Well done. All right, I've never really done a trapdoor on SPX. It only really works on Russell. SPX doesn't have that volatility skew that we looked at. And also the strikes are a bit trickier with SPX as well. Russell's probably the best out of all the indexes for trading options on. All right. The next thing I want to show you is how to deal with earnings. And certainly trading over earnings has risk, but some people want to take those risks. So I'll show you a way that you can do it as long as you're sort of aware of the risks involved. Nvidia's got earnings next week, I think on the 17th. 17th. If we go here to Market Chameleon, again, this is free, not logged in or anything. We can see what it's done in the last few releases. Okay, so this is the expected move. Now, this is kind of a bit more of an advanced topic as well, but if you take the at the money call and the at the money put and add them together, it'll give you the expected move for that particular time period. So here you can see 7.8% is the expected move for Nvidia. It might move up or down 7.8%. That's what the option market is expecting. We can kind of verify that number, and I'll show you how to do it. Thankfully, you don't really need to verify it, but just for interest's sake. We take the expiration immediately after the earnings date. Stock's at about 307.5. So that's that one and that one. Now, again, we'll bring over our Excel. The call option is at, say, 10.20. The put's at 13.80. We add those together. Gives us 24. Okay, you got that? That plus that. That's the at the money straddle immediately after earnings. Stock price is 307.80. If we take that divided by that, there we go, 7.8%. So now you know how to calculate the expected move of a stock over earnings, or you don't really need to do it, but at least you know where this number's coming from. So option traders, market makers are expecting that the stock is going to stay in a range of up or down 7.8%. Yeah, I can share that link. These are the expected moves for the past 1, 2, 3, 4, 5 earnings moves. I guess if you have a paying account, you can get the full history if you want, but I'm really only interested in the last few. So last time it moved 4%, stayed within the range. Time before that it went down 1.4, stayed within the range. This time it moved down 8% outside the expected range, inside. So we can see 4 times out of 5 it stayed within the range, and 3 times out of 5 it's had a positive move. So NVIDIA is a really highly rated stock. Technically it's really strong. Nice uptrend. Let's say we think over the earnings next week, NVIDIA is going to A, stay within the range, and B, we think it's more likely to be bullish than bearish. Okay, let's say that was our opinion. What we could do is we could trade a bull put spread. So again, let's bring our Excel over. The market is saying, of course, we don't know what the market's going to do. This is just an estimate, but the market's saying they're expecting it to stay above 283.80. That's the expected range on the downside. The expected range on the upside would be 331.80. So you could do a condor with your short strikes at 280 or 330, or as I said, if we think it's going to stay within the range and more likely to be bullish than bearish, we can do a put spread below this expected range. So NVIDIA, November, 283.80 was the expected move. That's about an 18 delta if we're below that level, or 20 delta if we're a little bit closer. So we could sell that one, buy that one, or there's slightly less volume there. I'd probably be inclined to do the 280, 275. Get rid of those other ones. So we sell that one that's outside the expected range, and we buy that one as our protective leg. And what's our expiration date? November 19th. So now we've got a bull put spread that's placed outside the expected range and is bullish. Yes, the expiration should be closest to, or the first one immediately after the earnings date. Yeah. And here's another thing about volatility around earnings. Remember, we talk about every single option strike has got different volatility. This is already kind of expired, but so it's not a great example, but this option expiring, all these options expiring on November 19th are after earnings, so they have exposure to earnings, 64% volatility. These ones expired on the 12th, or tomorrow, I guess, 45% volatility, much lower volatility because they don't have exposure to earnings. Makes sense, right? So again, something to be aware of. Okay, so the main risk with the trade obviously is if the stock drops. We're going to lose because it's a bullish trade. we are going to get volatility is going to come down after earnings, which is a good thing. We've got negative Vega, so that's going to help us a little bit, but it depends how much the stock moves. If the stock moves down a lot, we're going to be in trouble. We're going to lose money. But we're going to make money if the stock rallies or stays flat, even if it drops a little bit, because we're going to get that volatility crush, IV crush they call it, after earnings. The other thing to be aware of is there's a little bit of risk here if the stock stays or gets in the zone between 280 and 275, because this short put is going to be in the money and it's getting close to expiration. So we've got expiration risk. So that's the main thing you've got to be careful of there as well. So more of a higher risk trading strategy. Earnings, we see Snap a few weeks ago dropped 20-25% on earnings. Coin dropped 10%. Lots of other big names have been dropping quite severely on earnings the last couple of weeks. But that's how you would do it. Of course, if you're bearish on a stock, you'd do the opposite. You'd sell the call spread. There's really not a lot you can do to manage, Anne, in terms of adjusting, because it's so close to expiration. Once that earnings comes out, it's really kind of a hit or miss trade. Either the trade's going to work or it won't. So there is a chance that you could suffer a full loss on this one if Nvidia drops, 15% after earnings. You're going to be sitting down here at pretty much a full loss, and there's really not a lot you can do about it at that time. So again, that's why it's a bit of a different type of trading strategy. You could do an iron butterfly, Edward, sure. So some people will do the sell the straddle, which is obviously quite risky. So they sell the naked call and naked put at the money, hoping that the stock's going to stay within the range. Most of the time that's going to work, but then every now and then you'll get a stock like Snap that drops 25% and you take a big loss. But yeah, if you do the butterfly, then you're obviously protecting the wings on the upside and the downside. Fred, yeah, you would want to close it either the day after earnings, or, if Nvidia has a massive gain after earnings and you're sitting up here, there's really no need to close it out. You can just wait 2 days for it to expire, right? But if it's sitting down here, if it drops a little bit and it's sitting in here, you might still have a small profit because of that IV crush and the time decay. You'd probably want to close it out if it's getting close to that 280 level. If it's a full loss on Nvidia, you can opt for keeping the stock. Yeah, if you've got the capacity to do that, sure, it's going to be 28,000 times 2. You're going to get assigned on quite a lot, but you could potentially close the put spread for a loss and then buy some shares. Doesn't have to be 100. You could take the put spread off and maybe roll it out, roll the exposure out in time, roll it down in price a little bit. There's a few little things you can do. Yeah, how far out from earnings? Minimum 1 week usually. Yeah, 1 to 2 weeks is probably okay. Probably not any further than that. Yeah, you could do a put broken wing butterfly. Yeah, let's take a look at that. So we haven't really covered broken wing butterflies, but let's take a quick look. So let's say we buy 290, we sell 280, buy 275. Let's see how that looks. So we buy 2 of those, we sell 4, and we buy 2. That's a broken wing butterfly. I've done that the wrong way around, haven't I? Should be, we need the 270. So we actually want to have a bigger gap on the downside. Still messed it up, sorry. So something like that, where you're actually creating the profit zone around that expected move, could be okay. That's got 0 risk on the upside. If you wanted it as a bullish, more of a bullish trade, you'd go a bit closer to the money. So maybe you'd buy 300, sell the 290, buy the 270. So let's see how that looks. Buy 2, sell 4, buy 2. No, that's not even looking, that's actually worse. So yeah, broken wing butterfly is not really easier to set up for that one. And maybe that's because it's so short term and because of earnings. And yes, December would be safer in terms of the assignment risk, yeah, because even if the stock goes in the money, probably unlikely to get assigned because there's still going to be lots of time value left. So yeah, absolutely. If you're a bit worried about assignment, you could go out to December for sure. Let's have a look. The volatility is still going to be pretty high for December expiration. 51%, not quite as high as that 65%. So you're not getting as much bang for your buck in terms of selling the volatility, but certainly a little bit safer, a little bit less riskier. All right, so what was our initial one? I think it was selling that one, buying that one. So again, set that up in your paper trading, see how that goes over the next week. All right, any other thoughts on things that we want to cover in terms of reviewing strategies and delta hedging, volatility, position sizing, anything we want to go over? So the members page will be up indefinitely. You'll always have access to that. I won't take it down. If you want to go back and look at any of the replays or the case studies and downloading the resources. Same with the chat room. I'll leave that open for a while. If you've got questions, you can pop them in there and access all the data there. So Paul, net buyer versus net seller. So that comes back to volatility. Remember, if we go to our watch list and we filter by IV percentile, stocks with a high IV percentile or IV rank, we want to be net selling options. Then we want to look for stocks with a low IV percentile, and we want to be looking at buying options on these types of stocks with a low IV rank. So once we're getting our ideas, we then want to go and look at our volatility chart. So one of the high vol ones was InMode, really high IV, that white line, much higher than it was a few months ago, down at 46. So generally want to be a net seller of options on InMode right now. And then what was one with low Volta? I think Square might have been one. Quite low volatility compared to what we've seen in the last 12 months. So you want to be probably a net buyer of options there, or certainly be thinking long and hard about whether you want to be selling options in that one. CCS, AAL, other examples. So if I'm looking for condor ideas, probably not going to be doing condors here with volatility. Even though it's 40%, that's quite high compared to what the stock has been in the past. It's quite low. If you've got questions on P&L spreadsheet, maybe just email me. I can walk you through how to use that. What's the minimum IV rank to sell? Probably about 50%, anything above 50%. How do I choose between 20, 50, 15, 10 delta for put credit spreads? Well, usually I'm around the 15 delta. Is kind of my sweet spot. You can go closer in if you want to be a bit more aggressive. I wouldn't go too much further out than 10. The NVIDIA one that we looked at was based on the expected move. So we calculated that expected move of 78.8%, came out at about 283. So we wanted to put the short strike below 283, just happened to be around that 15 delta as well. AHT, is that a stock you wanted to look at? Yeah, really low vol compared to what it's been. Looks like a bit of a don't know much about the stock, so it's probably pretty volatile if we've got 80% volatility. Yeah, probably one to avoid unless you're pretty experienced, because yeah, we've seen volatility up at 400%, 200%. So high vol, even though the IV rank's probably going to be pretty low. Yeah, IV rank and IV percentile is low, even though the IV is really high. It's because compared to the previous IV we've seen for that stock, it's quite low. Yep. All right, iron condor adjustments. Cool. So let's find, I guess, let's go back to our OIH example. Let's say we didn't have our delta hedge in place. You can see clearly we're getting closer to the downside. So we'd want to maybe play a bit of defense here. Again, this is kind of close to expiration, so more inclined to close than adjust. But if we wanted to adjust, we could take this off, move it down a bit lower. So we'd close this one out and then we'd reposition here, buying 2, selling 2. Reduces our profit potential a little bit, but gives us a bit more margin for error on the downside. That's really the simplest adjustment, is just rolling the strikes down, down in price, or if the stock's going up, rolling out in price. That's adjustment option number 1, probably the easiest one. Second one, and you can do a combination of these two as well, right? Would be the delta hedge that we've talked about. Really simple little adjustment. We've got 11 delta. Selling 4 shares brings the delta down to 7, helps to flatten that T+0 line a little bit. You could even go slightly higher with the delta adjustment to flatten that T+0 line even more. Those are kind of the 2 strategies that you should really learn. There's lots of other different adjustments that you can do on condors. We can kind of discuss those in the chat room if you want. We haven't really had time to go through all of them, but those are probably the 2 easiest and most common that I'd suggest you start with and get your head around. And then if you go back to the week 2, I think it was, when we looked at that Facebook and Alibaba example, the Facebook one we actually rolled out in time as well, which is something you can do also. So here, let's say we're going into that last week. We could keep the call strikes the same and we could roll out maybe another 2 weeks. So 1, 2, keep the call strikes the same, maybe 255s, only a delta 5. So I'd probably even bring the call strikes in a little bit. And then on the put side, we're going to be able to roll out a little bit as well. So here what we would do, our current position has got $80 in premium left, $80 in profit potential left in the trade. We'd take off this condor and we'd reposition here. December 3 expiration. We've actually given ourselves a bit more room on the downside, and we've generated a lot more premium as well. We had $80 in premium or profit potential. Now we've got 180. We've generated $100 in premium, and we've also helped adjust our condor and fix it a little bit. Could have also brought these in maybe a little bit more even. Yeah, Paul, you could use a butterfly. Yep. My preferred method is the delta hedge. So that was our current position. That creates a similar kind of structure where we're lifting that profit zone up a little bit. What you're talking about is adding a butterfly to protect this short strike. If we're confident it's not going to get below 195, we would add 200. So we're adding a butterfly here with the short strike in the middle. So we buy 1, sell 2, which would take it to -4, buy 1, which would take it to 3. So yeah, something like that looks reasonably good as well, actually. Yeah, so don't mind that idea. Yeah, good suggestion. Let's go back to our initial position, which, as I said, probably time to close, or even rolling out in time and going to this sort of setup would be reasonable as well. I really don't like taking these trades into the last week when we're starting to get, reasonably close to that short strike, or quite unbalanced, where, we've got 23% on the upside or 21% margin on the upside and only 7% on the downside. All righty, great questions today. That is pretty much it in terms of what I wanted to cover today, and pretty much for the course. So I hope you've enjoyed all the webinars. As I said, the members page will be up indefinitely. The chat room will be there, an email if you've still got questions. But go through those, set up those examples that we talked about today and follow them along, and make some notes on them and ask questions and see how they go, and think about how to manage them over the next couple of weeks. The trapdoor, the PayPal one, the NVIDIA earnings one. Still a lot of learning that can be done over the next couple of weeks. Alrighty, well, I'll get the replay up for you all, and enjoy the rest of your day or evening. And as I said, just keep asking questions in that chat room. That'll be there for a number of months still, if you've got further questions. And thank you for all the feedback as well. Really appreciate that. Any more feedback, always welcome to get that. And yeah, don't be shy. Reach out anytime, and best of luck with all your trading. Take care, everyone. Talk to you soon.